big voice. It's Pranjul Bhandari, the Chief Economist for India at HSBC Securities. Hi Pranjul, it's always a pleasure chatting with you. Thank you so much for joining us this Friday afternoon on Markets at Noon, and more importantly, a day after the RBI credit policy as well. So, I was going through your note in which you talk about the repo rate being 5.75% by the end of this financial year. That means you're only factoring in one more rate hike in the new financial year. Have I got that right? Do you think you'll have to maybe revise that given the global uncertainties, the way growth is also being impacted? Maybe the central bank will have no choice but to give growth a chance using interest rates.
So, yeah, thank you for having me today. So, of course, yesterday the RBI cut the repo rate by 25 basis points, and we're expecting one more rate cut either in June or in August, taking the repo rate to 5.75. Now, to your question, whether it should and it can cut more than 25 basis points, at this point, I don't see the space, and there are two good reasons for it. The first reason is that both headline inflation and headline growth are low today. They are soft today, I agree, but as per our forecasts, both are going to rise up over the next couple of quarters. Headline growth, if you look at GDP growth in the economy for the last, say, 40 years, always a quarter or two right before national elections, GDP actually falls because the private sector postpones spending because of political uncertainty. By that same logic, once general elections are done, political uncertainty gone, private investment, private spending picks back up, and therefore we think we'll go back into the 7% plus growth range in the second half of 2019. Look at inflation. Today it is sub 4, with food at 0%, but we think food inflation is going to rise a little bit, not a whole lot, a little bit, from 0% now to about 3.5% by March 2020. We are already seeing rural incomes, real rural incomes rise. On the back of that, there should be some demand pressure on food prices, and taking all of that together, we find inflation going to the 4% target range by March 2020. So with growth higher than 7% and with inflation at the target of 4%, I don't think there's a whole lot of space out there for the RBI, to cut rates more. And my second point is that, both headline and headline growth and headline inflation numbers are soft today, but look at the underlying momentum. If you look at core GVA, or if you look at core CPI inflation, both of them are quite elevated at this point. Means that the underlying momentum is not as weak as what the headlines suggest. Again, taking away space from too many more rate cuts right now. So I will stick with my one rate cut. I'm comfortable with that for now.
Okay, so one more repo rate cut of 25 basis points. Pranjul Bhandari is predicting for the rest of the year. But Pranjul, before I hand it over to my co-anchor Pankaj, I had one more question for you. Right, from the last financial year into this one, what has been a bigger concern and what the central bank is also perhaps focusing a lot more at right now is liquidity. Yes, a lot is being done for liquidity, but nowhere are we back to the situation that the economy was accustomed to. Having said that, while we're also flirting with ideas of the liquidity injection mechanisms being introduced by the new Governor Shaktikanta Das, forex swaps, all of that, do you think maybe a missed opportunity when it comes to the CRR? Do you have any predictions as far as the CRR goes? Should the CRR be tinkered with at all?
No, look, I really don't think so. I think CRR at 4% is almost the bare minimum at which it should be at this point. And if you really want to cut it, you should do that only in a crisis situation when there's no other instrument available, and therefore you have to tinker CRR. We're definitely not in a crisis situation right now. So I think tinkering the CRR will just not be the right policy right now. Having said that, I do have a few thoughts on liquidity. The RBI has done a lot of OMO purchases last year. It's doing the FX swaps this year. It's instilling a lot of domestic liquidity into the market. My own reading is that liquidity situation is going to definitely improve over the next couple of months, particularly after elections. And let me explain why. Last year there was a huge liquidity crunch because RBI had to do a lot of FX dollar sales because the rupee had come under pressure. We're not seeing that situation in this year. In fact, our inflows, our BOP, our external finances are looking good. So that channel of, liquidity deficit in the economy will not be there this year. At least it's not there right now. And second, currency in circulation. Last year there was an unexpected huge acceleration in currency in circulation, but as and when election ends and the government actually increases GST tax compliance, more activity moves from informal to formal sector, we would see that huge acceleration of currency in circulation ease a little bit, and that will also be good for banking sector liquidity. So in my own view, in the next couple of months, banking sector liquidity is going to improve a whole lot.
Right, Pranjul, recently you've written a note regarding there is a glitter in India's economy and questioning that will it last or not. What are the key things that you think are needed so that this glitter can last?
Yeah, thanks for that question. A lot of changes have happened, especially in March. For example, the Fed, has sort of shown a reversal in its policy, not hiking anymore. This kind of a stance by the Fed is generally good for inflows into emerging markets. And on the back of that, we've seen inflows into India, $6.6 billion of portfolio inflows in the month of March. The rupee appreciated 3%, stock markets were up 7%, and that's the glitter I was talking about. But my point is that to sustain this glitter, India will have to do a lot of important reforms. See, let's look at each source one at a time. The best source has been BOP. Our external finances have improved. Current account deficit is narrowing because oil prices are falling. Inflows are rising because Fed has changed stance, and there is some sense that India will have a stable government, and therefore more inflows are coming into the country. But having said that, a lot of vulnerabilities still remain. If oil prices were to rise a little bit, again India's BOP will come into trouble. Remember, all the inflows we are seeing right now in the month of March, they can easily slow, stop, or even reverse. We've seen it far too often that these flows can be quite fickle. What India really needs to do in order to maintain its sheen is to undertake reforms. One big reform is to improve export competitiveness on the external front. India's exports fell by 4% of GDP between 2014 and 2018. We're actually very vulnerable. It's only low oil prices that makes us look good right now. So we really need to work on these vulnerabilities, improve India's exports competitiveness at this point. That's one very important reform. The other very important reform is reining in the fiscal deficit. The central government, state governments, PSC, all of these borrowings have become very high. And what is happening is that transmission of repo rate cuts is not getting into the government yield curve. The government yield curve is very, very steep. In order for that to happen, India has to rein in its fiscal deficit. So these are two very important reforms for the short term that the government should really consider.
An important point you made is about most of the central bankers across the globe being dovish, and that should be taken as a positive situation for flows into high growth emerging markets like India. But what do you make of the inversion as far as the yield curve is concerned? Do you think that is something which you're worried about? It's a development which one should talk about, and generally you never talk about FII flows. So is it such a meaningful development that everybody has started to look at FII flows and how they can just accelerate in a period of 1 to 2 months?
Yeah, look, I think that's a great question, and that's where I was also trying to question the longevity of the glitter or the sheen that we are seeing in India on the back of these portfolio inflows. They can reverse very quickly. True that many central banks around the world are calling for softer monetary policy than they were in 2018. But what is the reason for that? The reason for that is slower world growth. And so slower world growth will definitely weigh on all the inflows which, emerging markets like India experience. So while loose monetary policy around the world is good for flows into India, the fact that they are driven by slow global growth is not good for India. So overall, the inflows we are seeing right now may not last. So I completely agree with you that this portfolio inflows that a lot of markets is very excited about is not something that could last, and India really needs to do reforms on other fronts like export competitiveness in order to maintain its external balances sheen.
Right, Pranjul, thank you so much for taking out time for us. Always good to get perspective from you. There was a view coming in from the Economist at HSBC that rate cuts may happen going ahead and flows are important to track and what needs to be done to sustain those flows.